Thanks for being on, Phil. I think we've known each other for a few years, but this might be the first type of collaborative marketing we've had the chance to do together.
Yeah, thanks for having me.
Yeah. So look, I mean, I always like to start these videos out with a bit of an intro. Obviously, I hope people watching this know at least what we do for our clients. But you have a bit of I guess, a unique aspect because you kind of have two different jobs and two different roles with companies at different stages. Go ahead and give us a quick intro on a little bit about your background, how you got where you are now, but what you're doing between the two firms that you work with.
Yeah, so I came up at Capital Advisors Group managing short duration cash for VC-backed companies, and we started doing debt consulting, much like what you do on a day-to-day basis. That was the first 10 years of my career, and then 9 years with Square One, which turned into Pacific Western, which now is Bank of California, and ran the Boston office, having both tech and life science companies in the portfolio. While doing that, I did some angel investing myself. More recently, formalized that into a fund with my partner, Stefan, which is kind of a side hustle of sorts, a bit of a passion project where we've got limited partners that are all folks in the New England venture ecosystem and investing alongside seed stage, the first institutionally led round. Where I spend most of my time is with Trinity Capital, deploying venture debt into growth stage companies. Think Series B, C, D, pre-IPO, companies with scale, product market fit that need a little more fuel in the tank to get to either break even or an exit.
Yeah. It's funny. So I think you and I had very first connected briefly right before the pandemic, and you were at Pac West or Stifel at that point.
Yep.
And it's funny, before you and I reconnected after you joined Trinity, I had actually worked with a couple of companies that you had invested in through Service Provider Capital. So it's kind of a small world there. So you have the benefit of sitting in two different seats: early stage venture, growth stage credit. What are you seeing as far as the biggest changes on either side the past, call it 18 to 24 months? I'm sure you've seen a lot. I'm sure some sides have changed more than the other.
For sure. So if you look at the early stage deals that we did for the equity fund for Service Provider Capital, there were many who got over their skis in terms of burn in the 21, 22 cohort. Some of those have figured out product market fit and now have more discipline on the spend side and will be poised to do a nice up round. There are others who burned to grow or burned before they had product market fit figured out and their go-to-market sorted, and some of those have gone away. The cohorts from 23 and 24 came out of the gate with the spend discipline that I think has served them really well. And I think that cohort in particular, not to say there aren't outliers on either side, are going to be well positioned going into 25 to raise an up round. On the credit side, and I guess going back to that early stage equity side, there are enough well-funded early stage VCs that market has continued apace, and valuations have gotten squeezed a bit, but there's still good deals to be had. In contrast, the growth stage VC world locked up in many ways. The BCD rounds just simply are not getting done, with VCs putting the focus on triaging those portfolio companies through, the whole survive to 25 mentality. So a lot of inside rounds, flat, down, potentially. But the good thing is there's a whole lot of really nice assets out there that have unit economics figured out, CAC to LTV that makes sense, that have line of sight to break even. And those are awesome candidates for our venture debt product, because many of them were priced in 21 and 22 and have this aspirational valuation that they need a little more time to reach. So we're seeing a really nice cohort of deals that fit that model. So 24 was a great year in that regard, and I expect that to continue into 25. I'm hoping that we see some additional liquidity come into the market so that those funds that are towards the end of their investment period can go back out and raise the next fund.
Yep. Yeah, I don't know. For those of you that aren't familiar, I don't know if there's something in the water at Trinity or what, but I think you guys are hiring like 10 people every month, it seems like. Every time I see, I take another look at your website, you have a bunch more people added, more deals announced. So you guys definitely have something figured out in the space. One thing I find interesting, because we overlap a lot on the Trinity side, of your profession. So, we've seen a lot of companies that were frankly horrendous financial profiles up until probably early 23, where they finally figured it out. And I don't know about you, I'm seeing a lot of companies where they figured out how to grow still like 25, 30%, but at a break even pace or very close to it. And, we're seeing a lot of companies say, look, we have a decent valuation. Could we raise at slightly above it? Sure, but it's going to be heavily dilutive. So, instead of getting to break even, let's continue growing at maybe 30 to 35%, a steady burn versus what I'm sure you and I saw a ton of a few years ago, where it was trying to hit that 50, 70% year over year growth. But that whole rule of 40, concept seemed to be out the window because equity was so cheap.
Yeah, 100%. And it's amazing how quickly our friends in the venture world change their marching orders from burn, grow at all costs to fiscal discipline.
Yeah.
You know, it
But
seems,
still keep growing
but
aggressively.
still keep growing, right? Exactly. Um, yeah, I mean that's 100% what we've seen. And like I said, there's this whole cohort of really nice businesses that might not have the growth rate to command a significant up round from VC, but might bump along at break even, burn a little bit of money, and then I potentially see private equity coming in to roll up a lot of those assets. For the ones that are lucky enough to raise a round on terms that are acceptable to them, I think they're poised for significant growth simply because they've had to be so disciplined over the last couple of years and really figure out the business model.
Yeah, we've been talking to a handful of investment bankers over the past few months, just kind of what 25 will look like. Because I'm sure you heard it too. About a year ago, people were saying 24 was going to be really good, and it was in a lot of ways, but it wasn't quite that rebound to the M&A and IPO activity I think a lot of people thought was going to happen. But there seems to be a broader sense of optimism on all fronts going into 25. And they were saying something similar where, once you get to those very large private equity type of transactions, your return is really compressed because you're paying so much, and then your liquidity market is so narrow. The lower mid market, where you and I start playing a lot on the tech side of things, there's so much opportunity because it's a lot easier to buy 500 to $700 million worth of a handful of companies and flip it for a billion to a billion two, rather than buy $3 billion tech company and then flip it for more than that. So I'm hearing more lenders, probably on the smaller side, a little bit below where you guys might play at Trinity, tell us their portfolio companies on the smaller software side have been gobbled up a fair amount this year, especially those founder funded or lightly investor backed companies. I'm assuming waterfall preferences were a lot easier to accommodate there, but it seems like we're moving in the right direction. So yeah, hopefully as next year comes about, and you guys work with a lot of companies, I'd imagine that their next step is IPO, right? No.
Yeah, hopefully we see a thaw in that market. There's definitely a backlog. In talking to the same bankers that you speak to and lawyers, they expect Q1, Q2, a whole lot of activity.
Yep. Yeah, it's funny. I was talking to a banker at Wells Fargo yesterday, and he was saying he's been giving the same advice to clients since August and September. They're like, "Well, what do you recommend we do? We have our maturity coming up on this, next year." And he's like, "Look, I'm telling you the same thing I'm telling everyone. Are the capital markets open to you right now? Yes. Will they be at the end of the year? Yes. And they will all throughout next year. The problem is every company is asking themselves the same question, and you can't all go through the same window at the same time. So hopefully that means there's a steady growth through next year versus a huge rush, and then we end up going right back in the same direction that we did a couple of years ago.
I think there's been some religion found in those capital markets, and I'm
Yep.
hopeful that the candidates for especially IPOs are the healthiest. I mean, that's typically what gets out first, and that we don't spoil the party with a few that are stinkers.
Yep. What so Trinity is one of the you guys are one of the bigger names and when it comes to venture debt. If I type in venture debt right now, it's a couple of your competitors and you guys that pop up on the first page. What I feel like is a little bit different about you guys is, yes, you look at the cap table, but it's not the number one thing you look at. I know I've sent deals your guys' way that I never thought you guys would be interested in. You jump all over it. Vice versa. I've sent some deals where they have all the right investors, and you're like, that's great, and we like them, but it's not the right business for us. So since you started was it 3 years ago now, 3.5 years, what have you seen as the biggest shift on how you guys focus within the credit ecosystem, and how the venture debt market ecosystem has changed a bit? Because I know where we focus, is both where you guys play in a little bit outside of that, but from your perspective, what have been the biggest changes?
I think we've been pretty consistent in our approach. What I talk about with my team is coming up with a proprietary investment thesis on these deals. And what I mean by that is you have to believe for yourself that there's viable enterprise value, IP value, revenue durability that gets you home in a downside scenario. I think there are others in the market that, for better or worse, look at the cap table and look for blue chip investors. And bottom line, they're going to do what's best for their LPs. And
Yep.
and blue chip though they may be, it doesn't mean they're going to throw good money after bad. So
Yep.
I
Top VCs usually aren't. They're not the last in line to put money in their top companies.
yeah, and it's the lazy man's lobster way of underwriting these things to
Yeah.
just say, okay, X West Coast fund, I'm not going to name their names, is in this deal. If you're out of a $4 billion fund and they've got 3 deals that return the whole fund, what's their incentive to support one where they're not going to return capital?
Yeah.
There's a lot of different ways to look at that. So some of the VCs that we're biased towards are those that have the ethos of no company left behind, where maybe
Yep.
they're not looking for the 100x deal. Maybe they run their models off of 3 to 5x, and they don't want to take any zeros, and they know how to triage deals. And also there is a relationship aspect that's really important, where you have partners on the other side of the table that are equity investors who want to see you get made whole,
Mm-hmm.
um, because you've got scale with them. And we've run into situations where it's a less than optimal outcome for equity investors, but those equity investors are working hard every day to make sure we get paid back, and that goes a long way with us.
Yeah, I mean, there haven't been many deals we've worked on that we've heard of a downside scenario. I mean, I can think of a few, um, and from everything I've ever heard of them, it wasn't the company, beyond the company running into some issues. It wasn't the company management. It wasn't the lender saying, "Hey, this is we're just pulling the plug here." It typically tends to be the equity investors, and it's unfortunate. It's like a lot of things, a few bad eggs, spoil the brand for everyone else. But
Yeah.
there's a buddy of mine, actually. He's a head of business development at a tech company, doing really well, and they took on VC capital, and they got a great valuation on it. But what he said the board ultimately decided to go with on the offer that they got was because the VC that came in, each partner was allowed to do one deal a year, and they had to get somewhat operationally involved in the business because their whole thesis, like you said, is no company left behind. They're looking for steady incremental growth across the portfolio, knowing you will ultimately have some losses and some challenges, but you cater to 2 out of 25 portfolio companies. Companies don't realize that big brand name might not always serve you the way that you need when you run into issues there.
100%. I think for entrepreneurs going through this for the first time, there's a perception that money is money.
Mm-hmm.
And what you have to think about is how much currency does the partner leading your deal have? Will they be able to shake loose additional dollars in the future?
Will the
What?
firm stand behind you if that
Yeah,
partner leaves? That's something we've run into before.
totally. If it's an orphan company like that, what vintage is the fund? How much dry powder do they have? Do they have a lot of winners in the fund where they might be able to recycle that capital? Or looking at that the other way, do they have a lot of winners in the fund where they don't care if they, you know,
Yeah.
orphan a company? So all that plays into it. Similarly, and this isn't something we specialize in, there might be a totally strategic family office or strategic corporate investor who would be a perfect match. But
Yeah.
then again, that's fraught with challenges in that if you lose your champion at either of those institutions, you risk, not having access to capital in the future. So I think the message to entrepreneurs is just really do your homework on who you're taking money from, and everyone's going to claim to have a value add, but really kick the tires on that. I think it's really important to talk to other portfolio companies that have gone through, the full life cycle with these investors.
Mm-hmm. Yeah. Yeah. Talking about companies as far as their capital goes, one of the things we've seen a big shift excuse me, over the past couple of years has largely been companies' view toward credit. I don't know about you, but we saw a lot of companies in 2020, 2021, where obviously we're taught our entire lives avoid debt, credit card debt, student loan debt, things like that. And I think a lot of companies or management carried that into their businesses. But over the past couple of years, we've seen companies realize, oh, debt's actually not a bad thing for my business to have. It's not going to hurt me the next time around. Because I got that question a lot, where they're like, hey, we're doing 8, 9, $10 million a year. We want to borrow 4 million, but how's that going to hurt me when I go to raise my Series B next year? I'm like, it's not. I mean, you're not taking out MCAs. This is a credible institutional credit provider. And what we've seen is a big shift in the view companies have toward not only debt, but lenders and how they work. And they are looking for that relationship. How are you going to operate in a downside scenario? We've had more companies do more research on the lenders out there that we're bringing to the table and saying, how have you worked in this situation? How have you done this? And again, to your comment, money is not just money. There's a lot that goes into it.
100%. What I said about VC money applies to venture debt as well, and who's going to be a good partner as your business evolves, who's got extra capacity to lean in if things go well, and who's got the pattern recognition of understanding the bumps in the road. Certainly what we're taught about debt is true to some extent. You don't want to lever up before you have the business model figured out and you understand the repeatability of your revenue stream. But at the same time, especially in an environment like we're in now, where valuations have been compressed significantly, it can be the right tool to get to the valuation you want in 6 or 12 months.
Yeah, and that tends to be what we're hearing the most of right now. It's a clear path to profitability, or right now we're hearing a lot of exits, not a lot of next equity raises, because I think a lot of their VCs are a little long in the tooth in a lot of their companies. But yeah, it's been a good shift because, and I'm sure you're seeing this too. I'm guessing you get less sticker shock than you did a few years ago, because I remember, again, cash burning company, no assets, doing less than 10, $20 million a year in revenue. And, I would get questions where, why is this at the time 12%? It's like, well, because this is why. And they're like, well, my mortgage is 1.9%. It's like my car payments, 0.5%. It's like, okay, you're not buying a car. you're not buying a house. Like, well, I was reading that, they always cite something from like CNBC, commercial credit, and things like that. Are you seeing less sticker shock over the past couple of years as, a bank rate has been, between 8 and 9%?
I think there's a maturation of the venture debt market. And for the more sophisticated finance folks on the company side, they understand that our product, growth stage venture debt, is different than the bank product, which typically has covenants and is smaller in terms of quantum.
Hmm.
So there's good and bad aspects to that, in that there's definitely more competition and a smarter consumer on the other
Hmm.
side of the deals we're doing, um, and more value-added folks like yourself who are helping folks acquire the right kind of debt for their business.
Yeah, one of the things that we get sometimes, and, they're not invalid points, but it does show a lot of things on the type of consumer, in your terms, that's out there. Where, I think still a sentiment where you raise equity when you can, you raise debt when you want to. I get that a lot, where it's like, well, always been told you go the venture debt route when you can't raise equity, and I think you and I both know raising debt is, unless, except for like an MCA or something, is not easy. And equity, it might not be on great terms. Is, if you're a good company, equity can be a fairly easy route, but debt on good terms can be tricky because debt is downside focused. I had a conversation with a client where they're like, I'm not sure why anyone would pass on this. They're clearly not going to lose their money. And what I try to explain to them is that's a bank's mentality. Protect no capital loss at all costs. That's why you have covenants. That's why you're a $25 million revenue business, and they'll lend you $6 million on that. But a credit fund like yourself, you're also looking somewhat to the upside. You're obviously capital loss protection, but it's relationship oriented, and it's, part of your return is on warrants. Am I going to be able to, I don't want to send this company into bankruptcy to get my money out, but I do want to make some money on it. Have you seen a shift in companies' mentalities on things like that? Like, have you heard more of like, well, you're not going to lose money on this, or on the flip side, hey, now's the opportunity because you're going to make a ton of money on this, where you don't see the value in the business?
I think the warrants are a key piece of the structure of our deals. So we have that equity-like upside, but we're never going to do a deal simply because of a high volatility upside. If there is a high
Yeah.
volatility downside, we're always looking for a base case debt to EV that's defensible and we can sink our teeth into, not just that's what the equity guys are telling us.
Yeah.
And the whole venture debt model is those equity pops eclipse the losses you're going to take in this asset class. So sometimes we get pushback from equity investors or entrepreneurs saying, well, you have a guaranteed return on your investment. Why do you need these warrants? Well, the fact of the matter is, with cash burning companies and all the risk inherent in that, we need to have that equity
Yeah.
upside, albeit a sliver of any potential outcome. It just helps to smooth out the outcomes for us and our shareholders.
Yeah, and I think, you and I know as well as anybody, there's no such thing as a guarantee in anything. So I have heard that plenty of times. We're like, well, my personal favorite is my IP was valued at $400 million. It's like, by who? It's like, well, an appraisal firm. It's like, oh, okay, the firm you paid 50 grand to tell you that. So yeah, we get that a lot, and that's why I think, obviously you guys have been around for a while. You're one of the original venture debt providers in the ecosystem to do it at scale. And I think as more and more funds pop up, companies are seeing more value in it, not selling 20, 30, 40% of their business in a series A. They are looking at, it's good. I think, earlier stage lending options are popping up. And, we've had some companies, they did a seed round. I worked with a company last year. They were doing 49 million in revenue. They were, I think, 14 years old, but the founder owned, I think it was like 72% of the business, and he was happy as a clam. He had done a very small equity round, but it is amazing how many lenders he had talked to before us, because he Googled, and he went to some of the names that you and I know, and they're like, no cap table representation from our friends. And he's like, it should not be a good thing. I can run a solid business. So we've definitely seen a big shift where companies are leaning toward credit more and more. And I think it plays a pretty big role going forward, probably more than it has the past few years,
Yes,
which
private
would be
credit.
good for you and me. So maybe I'm biased.
Yeah, sure. I mean, private credit is having a moment. That what we see are definitely some tourists in the venture debt market. Um, when they have their first problem credits, we'll see how durable their commitment is.
Yeah.
But it's also, as I mentioned before, a reflection of the maturity of the asset class and the acceptance of it as a vital part of capital structure. I mean, this is a niche of a niche, right? You've got
Yeah.
venture capital, which is a niche of finance, and then venture debt, which is a niche of that.
Yeah.
But I think as any Series A going to B, going to C company that has some durability to their business, they're going to have the capital structure conversation. What level of debt makes sense given an X raise of equity?
Mm-hmm. Yep. Uh, yeah. So okay. So we're sitting here right before Thanksgiving of 24. What are you most excited about in 25 on either side, whether it's through Trinity, service provider, capital? What's getting you most excited right now as we enter what should be a pretty good year for everyone?
I'm really excited about our product suite at Trinity. We have 5 different vertical markets. I run the tech lending group. Adjacent to us, we have 4 other markets, one being equipment finance. Then we also have sponsor finance for those buyout deals, upstream private equity backed companies. We have our life sciences group, and then we have warehouse financing, which is doing SPV financing for fintech. So what we've done is taken our know-how in the tech ecosystem and kind of productized it into these different approaches. And I think what we've become is expert in these different segments of the market.
Mm-hmm.
But we're also referring deals back and forth to one another constantly because so many of the call points are the same.
Mm-hmm.
So I think as that's evolved and this has really taken shape over the last 12 months at Trinity, I'm excited about harnessing, that kind of 1 + 1 = 3 in terms of our go-to-market. So that's exciting. I'm also excited to see more of these growth stage companies that have endured the pain of fiscal discipline over the last 18 months, that have line of sight to break even and have supportive investors, because I think those are places where we can really add some value as they grow
Mm-hmm.
into their valuation. And then on the service provider capital side, it's kind of steady as she goes. Early stage deals keep getting funded. New England continues to be a hub of innovation for life sciences, certainly for frontier tech, and then the down the middle enterprise SaaS deals and insurtech, fintech and some odd consumer deal that we'll do here and there. So
Yep.
what I love about the New England venture ecosystem is we're blessed with a lot of smaller, hands-on, high integrity folks at the early stage. And I just love that ecosystem. What I think we could benefit a bit more from is a little bit more concentration of growth stage VC here. So companies don't have to go to the West Coast.
Yep. Well, look, yeah, thanks for being on. It's been good. It's always good to catch up with you. Yeah, hopefully 25 is as bright as everyone seems to be hoping, but I feel pretty good about it. We're definitely seeing trends in the right direction.
Sounds good, man.
Yep.
Thank you for having me. Appreciate
No,
it.
no problem. Enjoy your afternoon.